George of the jungle, strong as he can be.
Hello folks, and welcome to thecreditjungle.com. Today this is George Anderson, and this is going to be another little small segment here about reverse mortgages, also known as a home equity conversion mortgage. It's a HECM is kind of the industry term on it. And we're going to talk about the difference between a HECM and a HELOC, which is a home equity line of credit. Now, there are some things that are similar about these, and there are also some big differences, and that's what we're going to talk about today. And again, I'm not trying to promote or denigrate one product or another. All I want to do is just give information for something to think about on here. So let's just say that we have a couple that is over age 62, and let's just say that they have their home free and clear. Okay, but they would like to have some money for home repairs, for spending, vacation, debt consolidation, just fill in the blank, okay? And let's just say that they want to be able to tap, $100,000, $200,000 of the home's equity, and let's just say the home's worth $500,000. So there are a couple of things here that are similar on these is, well, what type of loan is it? Well, for a home equity line of credit, they are typically an adjustable rate, and you would have interest-only payments on it for the first 10 years. At the end of 10 years, whatever that balance is, then that will go to whatever the rate is at the time based on the index and the margin, which are going to be features of all adjustable rate mortgages. And then it will begin to amortize, and you'll have fixed payments over the next 15 years to be able to pay that off. On a reverse mortgage, for example, there is no payment on it, but it's still an adjustable rate. Well, if there's no payment, why does the rate matter? Well, the rate matters because the rate at which that balance goes up, if rates are going up, like we have been in an increasing rate environment for the past couple of years here now, that means that equity is going to be eaten up much faster based on the index and the margin of what that's going to do on that. Now, the thing that's different here, let's talk about this, okay? The big hang up here for a lot of people is the payment. They say, yeah, but mom and dad don't want to have a payment, okay? Well, we're going to go over and visit this again after I present some facts here, but let's talk about the fees here, okay? Let's just say we're talking about getting a couple $100,000. Maybe that's the principal limit, maybe that's how much they want to borrow. There's some other calculations in here we're not going to get into, but the fees on that are going to be about 3 to 4%, of that principal limit. So if it ends up being $200,000, we're talking, in this case with a smaller amount, $200,000 is not considered a large sum of money. Those closing costs are going to be $8,000 at least, okay, on that. Okay, so there's quite a few fees on that. So we had about $8,000 in fees here for this, okay. What are the fees over here? Not applicable, okay. Most of the home equity lines of credit will only charge you the appraisal fee or some cancellation fee if you close the line within the first year. Okay, so huge difference in the closing costs here. How about the interest rate? Well, as I said, they're both adjustable rate mortgages, and adjustable rate mortgages have a margin, a cap, and an index, something that they are pegged to. Well, most of these are pegged to a treasury security or a basket of treasury securities. Sometimes it's prime, but anyway, they have similar indices that they are connected to that are going to move at the same rate as the Fed does what they do, and shorter term interest rates move up and down. The rate here on a HECM is in the 7s, okay? Same product, same adjustable rate, same type of financing here. The rates over here are in the 5s. Just remember, anytime that we're talking about money and getting finances, there is a cost associated with the money. There's going to be positives, there's going to be negatives. But do you want to spend $8,000 or have your parents spend $8,000 to get a higher interest rate, or do you want to have no fees, a lower interest rate, but have a payment? Well, guess what? When I've sat down with couples on this, normally on a reverse mortgage, these decisions are made by a family. They are made together. And when the kids understand how fast the equity would erode Maybe they don't want to live in the house. Maybe there's no, that's fine. That's mom and dad's house, and we'll just sell it when they're done and everything else. And if that's the case and the kids have no interest and the intent is to sell the home, well then that's fine, okay? But still, if that home, if they're going to have this transaction for 10 years, okay, which one is going to give them more equity? Well, this one's going to give them a lot more equity in exchange for a minimal interest-only payment on here. Maybe the family could chip in and help out with some of that. And that could be a determination for the inheritance or how the distribution of the estate would be handled after their passing. But this is fairly expensive money here, and when most people can look at both of these options, I just think it's something that a lot of people sometimes just realize that maybe not for right now. Let's find a different way to help mom and dad with their finances. So thanks for coming into thecreditjungle.com today. This is George Anderson. Push button, get mortgage professional, and I would be delighted to talk with you about your mortgage options and crunch the numbers so that you can have everything right in front of you. Have a great day.